Well, there you go. Now, Gerard, you trained the searchlight of your award-winning skills this week onto the question of global growth and how it's travelling this year. It's the third year in a row we've had a mid-year fade. Just tell us a bit how you see it and run us through a couple of charts we've got from your notes.
You're right, Alan. It's the third year. This year is a little bit more serious, I think. And there's two things that makes it different this year to the last 2 years. And the first slide I've got just shows business confidence. And we're starting off at a much lower level, closer to the boom-bust threshold in this slowdown. So if we do slip to the same extent that we did the last 2 years, we'll be in a world of contraction, at least in manufacturing. That's the first difference.
As you say, developed nations are under the 50 threshold already.
That's right.
Which is the level of contraction.
That's right. For manufacturing, not for the overall economy.
Yes.
But the other point of difference is last year the growth scare was very much a developed world problem and the emerging world stayed strong. In fact, what we had last year in Asia was policymakers concerned that growth was so strong they were actually tightening. Now we've had as much macro disappointment in places like China and India as we've had in Europe and the US. So it is a global growth scare.
And now your next chart, I think, is about how the markets and investors are reacting to that.
The market started to sniff this out. I mean, 2 or 3 months ago, what we saw in markets was very much a Euro-centric concern. This slide just shows performance in overall equities globally by sector. We're seeing the very economically sensitive sectors like resources, energy, big drawdowns. The typical defensives are still falling, consumer staples, telcos, utilities, but they're falling less. Investors are stampeding out of stuff that's sensitive to the cycle. And it's just another signal from markets that things are getting worse.
It's interesting, if you look at the BHP share price, and BHP is not a bad proxy for global growth one way or another, it is now back at its March 09 low. So when the stock market bottomed out in the depths of the financial crisis, BHP share price is back where it was. And I think that's very disturbing because commodity prices are a lot higher now than what they were back then. That only says that the outlook for BHP is, well, in the market's eyes, terrible.
Well, I think that's also a function of cost blowouts in projects that they want to do, and also a couple of really dud acquisitions in the US, which cost them about $20 billion, and some are suggesting there'll be big write-downs, maybe not this financial year, but certainly in the next.